This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
Let's dive into the Postgame chart book. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, that means you haven't registered yet for your free account at MacroVoices.com. Shame on you. You can get one by looking for the red button on our homepage at MacroVoices.com, just above Luke's picture that says Looking for the Downloads. Patrick, let's dive into slide 2. Boy, look at that big, bright red reversal candle. And of course, that's today's tape action. What does this tell you as the technician in the house?
Well, you know what? The big question I wanted to simply ask, one day never makes a new trend. And there's no way that, those people that are looking for the big crash in itself, it always starts with a big down day, but it doesn't always have to end in it being a crash. And so what I was really illustrating here was the fact that when you look back to February, when that crash candle started the sequence that began the COVID crash, it spent basically 2 days downwards and then never was able to recover. But if you look at what corrections we've had in the market since, and I only circled one of them, but you can see it at least on 4 or 5 different spots since the bottom, where the markets had what are these typical 2 to 3 day market corrections, and they often will give back a chunk of the prior rise. They'll pause and they get bought on dip. So I think the biggest puzzle piece for us to solve in the next week is, does this create a new feedback mechanism that creates some big new market event to the downside, or is this just going to end up being a buy on dip? And while I certainly feel that there are a lot of risks in the markets, and certainly we're starting from a very elevated level, which in itself can heighten the chance of this being deeper than expected, I think the jury's still out as to what we're about to see. And I think that maybe by Monday or Tuesday next week, seeing how the market behaves after the selling is, that's kind of 24 to 48 hours of selling is dissipated, how the market reacts is going to be a real big tell.
Well, Patrick, I agree with that. And I'd also point out that if you just look at long-term seasonality in the stock market, right around Labor Day is oftentimes a turning point or an acceleration point. So the notion that, 2 trading sessions before the Labor Day holiday, the fact that might be the time when things either start to reverse or make a head fake before actually accelerating in the prior direction. It all fits in. It's very consistent with what you tend to see this time of year. And I think I'm willing to wager that September will be a very interesting month. I'd say now through the election is going to be a very interesting time in markets. Is that an interesting downside time or an upside time? Well, I guess we'll wait and see. Let's move on now to page 3. You've got the FANG Plus Index. That's the expanded darling tech stock index. Boy, sure looks like the beginning of a blow-off top, but I guess it's too early to call it. What do you think?
Well, first of all, I just wanted to make the observation of just simply seeing the magnitude of this rise that we've witnessed since the March bottom versus even just the 2019 into early 2020 rise. This has just been an unprecedented rise in those tech names. And, Erik, I'll ask you, is a 30 to 40% market correction a big deal? Because in my mind, that's what we saw in the S&P 500 just back during the COVID drop. And what's amazing about this rise is that if the FANG stocks index just had a 30 to 40% decline, it would just be approaching its pre-COVID highs. It's just amazing to put into context of just how far the FANGs have shot to the upside and how much room there is for mean reversion, even if it's not breaking the bigger picture uptrend that's now been very clearly established. One of the big leaders in that big parabolic rise, and I want to talk about this in greater detail, and particularly some of the fuel that's been driving it, is on page 4, the Tesla chart. And similarly to the statement I was making, I mean, I'm not trying to forecast Tesla going down there, but if Tesla right now experienced a 60% decline, it would just be reaching the highs it put in prior to the COVID correction. And it's just amazing how far these stocks have shot higher. And so it asked the question, was this the Fed, right? Every person I hear saying is like, you know what, the Fed liquidity surge came in, driving the stocks. You can't fight this. These stocks are going to keep going up. And while I, in principle, don't deny or wouldn't even push back on the notion that that massive liquidity surge that the Fed put into the markets was, in fact, very real and driving the stock markets, and at least drove stability in the stock markets. The one thing that I feel that people are very quick to, or not discounting properly, is that while the Fed provided a certain amount of liquidity, it's the speculators that have driven this move. And particularly, there are different accelerants within this market that have driven the rise in these tech stocks. So going to page 5, we were talking last week about that chart that basically showed that now 75% of all options volume is now at 30 days or less, and often 2 weeks or less till expiration, which basically means that all of these options, and particularly the growth in call option volume, has now created huge gamma pull on the front of the markets. And this has been even further accelerated in the last week or two. On page 6, I have a couple of quotes that were out there. One from Citadel, one that says that over the past few weeks, there has been a massive buyer in the market of technology upside calls and call spreads across a basket of names, including Adobe, Amazon, Facebook, Salesforce, Microsoft, Google, and Netflix. Over $1 billion of premium was spent and an upwards of $20 billion of notional through strike. This is arguably some of the largest single stock flow we have seen in years. The average daily options contract traded on the NASDAQ stocks to rise from $4 million a day average in April to $5.5 million a day on average in August, a 38% jump in volume. So that's from Citadel. The point that they're making is that some monstrous institutional buyers are coming in with real money. This isn't Robin Hooders that are coming in driving this call buying volume. And this is creating a huge gamma pull on the upside of the market, acting like a fuel or accelerant to the upside of the market. It's sort of like hitting nitro in a car that's already going 100 miles an hour. But the one thing is that a lot of people are trying to say or suggest that this is now the new speed of the market. And the one thing that I look at this, when you're talking about such short-term gamma driven by these options, at some point that accelerant runs out and the rate of change of the vehicle would slow down. In the same way, there's going to be some counter reaction to this. And while I don't want to already be joining the camp that there's some new bear market that will take the market's all-time new lows, I think we are long overdue for a proper and deep market correction that reverts and backfills this big extraordinary move that we've had.
Patrick, I just want to add a comment to what you're saying. A lot of people would probably hear you and say, what are you talking about Tesla having a 60% decline? That's crazy. That's 1 in a million years kind of downside event. Look, for any stock to return back to the price it was at the beginning of the current year is not a once-in-a-lifetime event. It's a perfectly typical, normal thing to have happen. So, yeah, it would be a huge percentage. I think it would take about a 75% downside correction or bear market in Tesla just to get back to its January 1st opening price for this year. And, what goes up must come down eventually. This is a stock that, if you value it based on the viability of its business plan, has never been worth more than $4 a share. Forget about $450 a share. So, there's a lot of fluff and excess in this market. Does it mean it's going to come out, or is it just going to be fueled even higher by even more liquidity in the marketplace? Well, I guess we'll find out.
The one thing that I will put a thought out there, there's a new truism that is passed around today in the markets, which is that don't fight the Fed. The Fed will always provide the liquidity, and therefore the stock market can only go up because they're not going to let it go down. So you can accept that truism to be true, but there's another truism that conflicts with that in the market, which is that there's a long, rich history of the stock market separating fools from their money. And what you have to ask yourself is, which truism do you believe to be more true? Because only one of them is going to be right.
Well, Patrick, I don't want to be on the hook for answering which one's going to be right. So let's move on to something I actually know about, which is crude oil on page 7. As you can see here, although the last couple of days were pretty vicious, boy, isn't that, you're the technician here, but doesn't today look like it could be the beginning of an upside reversal candle? It wasn't a perfect doji, but it was pretty darn close. And normally I would say, hey, look, this market is just way overdue to roll over to the downside. We need a sizable correction. We're overdue for one. It's got to be the beginning of much more downside. But look at all of the times since June or so where I thought that was starting, and it turned out to be just a false breakdown. And after a couple days, it turned out that buying the dip was the right thing to do. Is this another one? Or maybe we're past the seasonality of summer driving season, and it really is time to have that correction down to, say, $35 or so that, frankly, has been overdue for quite a while. I'm not sure yet. I think the next couple days, next couple market sessions are going to be very telling. How do you see this chart?
Well, I don't want to look just at the crude oil chart alone. What one has to do is put it into the context of the broader intermarkets, because what if, and so let's just do a what if exercise. Well, what if the stock market just began a risk-off period where this period between now and the elections, the stock market has a lot of challenging periods and a lot of volatility. Let's not go much more beyond that. But during that period, we see money flow into risk-off assets. We see yields dropping as money flows into the 10-year Treasury bond. We see potentially a short-term low and a mean reversion in the dollar. If we start seeing that kind of an intermarket environment, I think that oil may still have more to drop. I do believe the major lows in oil are in. I don't know if we'd ever see negative oil prices ever again, but I do feel that if we go into a risk-off period, that could be something that drives oil to pull back into the mid to low 30s. But that would mean that those other markets would have to be doing that. If those things aren't happening, then oil could very easily bounce right back and just stay within this range, and this could be a fake out. But we'll see. The one thing I wanted to talk to you, though, about on page 8 is the crude oil term structure. And often we see some bumps in there that create some form of backwardation, but this is a very clear contango in the entire oil curve. What do you make of all of that?
Well, I'll also point out it's not shown on this particular chart, but if you see that bend in the term structure, which is right around June of 2021, about 9 months out on the curve, you see the angle of the line changes pretty abruptly there. That wasn't there. Well, it was there a little bit, but it wasn't nearly as pronounced a week ago. So as we're seeing the market start to sell off, what the market's telling us is, okay, contango is steepening about out to June of 2021. And then the term structure from there kind of follows a much more steady trajectory all the way out to the end of the curve. So I think that what that's telling us is the market's trying to figure out, okay, it's probably going to be that the market is rebalanced by June of 21. That's 9 months from now. But what happens from here? Are we about to see a bunch of more downside down to the low 30s or even below? And I think you could make an argument for as low as $26 a barrel from here. I don't think it would last very long, but that's plausible. I think in the low to mid 30s is probably a more likely downside target if this becomes substantial. Already the term structure is starting to signal that possibility at the front end of the curve, but you're noticing the back end of the curve isn't budging because it so far is discounting this, saying it's just short term for now. The front of the curve is moving on it. The back of the curve isn't. It's important to watch whether or not that this line continues to hinge at that same point. And if we do go down a little more, does the front of the curve steepen its contango and the back stays the same? Or does the back start to come off too, which would suggest that the market thinks this could be longer lasting than just a short-term correction? So it'll be very interesting to see what happens as this situation develops over the next few weeks.
All right, well, let's move on to page 9 because I wanted to talk natural gas. We're always talking oil, and I wanted to just take a look at this natural gas chart. And what we've seen throughout the majority of the summer of 2020 is a pretty clear bottoming formation establishing itself. And what many technicians are observing is a legitimate and proper bull breakout of natural gas prices. And they've sort of been marching to the beat of their own drum. But what's particularly interesting, and we'll talk about it in the term structure in a moment, is that we're going into the seasonal period where natural gas prices are actually rising. So, Erik, let's have a quick look at that natural gas term structure.
Well, Patrick, this crazy pattern you see, this sawtooth pattern in the natural gas term structure is actually to be expected. It always looks that way. The reason for that is because natural gas has a much, much higher storage cost than oil does. You can't just throw it in a salt cavern or a simple unpressurized metal tank and let it sit there for 5 years the way you can with crude oil. Once natural gas has been produced, meaning that it's been taken out of the natural well or reservoir that it has been sitting in for millions of years, in order to store it, it's much more expensive because you have to worry about temperature and pressure and specialized tanks and liquefaction and refrigeration and so forth. So what happens is because there is a seasonal use pattern and a seasonal demand pattern, the price and the expected price in the future tends to just be up and down like a sawtooth. And so this is entirely about annual seasonality. Each one of these big sawtooth patterns that you're seeing here is 1 year's worth of seasonality in the chart. And it always looks like this. What that tells you, though, is that if you're buying natural gas just because you were looking at a chart like the one on page 9, you're saying, hey, it looks like it bottomed there in July, and it looks like it's headed up. Maybe it's going to continue heading up. Well, this chart on page 9 is kind of misleading because if you're buying an ETF, they have to trade the actual futures contracts, which are shown on page 10, the little yellow dots. And sure enough, there's just a super steep contango right now. So that means each time they roll their contract forward, they're rolling forward, let's say from 250 now in the immediate delivery month to about 293 in the next month, and then 330 the month after that. It doesn't mean you're making that profit. It means you're losing ground. The new entry price is that much higher, and you didn't make any profit for reinstating your trade at that next higher price. So what happens is there's a really big tracking error between what appears to be happening on the price chart on page 9 and what the actual performance of an ETF or another instrument that invests in rolling natural gas futures. Now, unlike USO, which is the crude oil ETF that completely changed its composition to focus on a number of different contracts across the term structure, for the most part, the ETFs still roll that front month futures contract. So you're going to be subject to really big tracking errors, and it's important to really, really understand how those products work before you try to speculate on the price of natural gas based on a chart like the one on page 9.
You know, Erik, I couldn't agree with you more. The one thing, the UNG does still only roll its front month contracts. And so there is going to be a big tax on that roll. And it's going to be tracking quite poorly against natural gas in the next few months as we see these continuous contracts heading all the way to 340 on the upside in the next few months. What is interesting, though, is the considerably higher prices this year for natural gas versus the long term, because during this kind of 2021 to 2026 period, they're still forecasting and pricing in $2.40 to $2.80 natural gas prices. And yet here at the front of the curve, we are going towards $3.40 here into the tail end of the year. Do you have any ideas of what that is? My speculation is obviously with all the well shutdowns in the fracking space that is creating some short-term supply issues that many traders don't believe will be there in a few years. Do you think that that could be the catalyst behind that, or do you have any other speculations for it?
Yeah, in general, storage of natural gas is much, much more complex and involved than storage of oil. And for that reason, a lot of natural gas gets flared off. That's if you've ever seen a picture of an oil field and you see that thing that looks like a big blowtorch pointing up at the sky. What they're doing is they're burning off the perfectly good natural gas that's being produced because it's actually more economic just to burn it, throw it away, and waste it than it is to capture it and have to deal with the complexities of storing it. Oftentimes, these oil fields are out in remote locations. You don't have all kinds of equipment and electricity and so forth to be refrigerating liquefied natural gas. So it probably has to do with both the pandemic situation, further encumbering the complexity of logistics, and the fact that natural gas storage is inherently cumbersome and expensive to start with. As far as the particulars of exactly what's going on right now in this natural gas market today, I'm not a natty guy. You've got to really be one of the traders who focuses on and specializes in nat gas in order to really understand that, and it's outside my field of expertise.
Well, if any of our listeners have some insights on that, please feel free to share it with us. We'd love to know. Nonetheless, I want to move on to page 11, where I have the chart of the euro. And one of the things I referenced earlier when we're talking crude oil is just what are we about to witness on a broader intermarket basis? And what's interesting to me is that while we have had a pronounced U.S. dollar decline, which is to the opposite, a very strong euro, what we've seen in the last month is a number of times that the euro has tried to break to a higher high and rally, and each time it failed to hold the breakout and has reverted back. While it's very premature to already be trying to suggest that this is somehow a huge topping formation, there's no denying that many topping formations start by looking like this. And I think one of the bigger things to watch here in the coming days and weeks is whether or not at least short to intermediate move in the dollar has played out. We obviously a lot of our guests come on and talk the big picture, what's really in store for the next year or two. But I think that this is going to be a really important moment to find out what happens here on the next 1 to 3 month swing, and especially if the stock market feels very heavy. It'd be interesting to see if we have a dollar up a kind of risk off impulse here in the currency.
Patrick, let's move on to page 12. Boy, an abrupt reversal in Bitcoin as well as other assets this week. What's your interpretation of this?
Well, you know what? There'll be a lot of technicians that are going to be trying to call that a head and shoulders. There was an attempt just a few days ago for that flagging formation to bullishly break out, which should have arguably given the tailwind and impulse for Bitcoin to head toward 14,000 on the upside. And instead, not only does it reverse, but it reverses right at a key overhead resistance and subsequently breaks the consolidation on the downside. And so it's really interesting to find out whether or not this has solidified at least a short to intermediate top. I don't want to try and make the big call on that. But what's your take on it?
Well, I would liken this to dot-com stocks in the late 1990s, and I think it has to do with the sophistication of the market versus the complexity of the underlying asset. The market was right in the late 90s to think, hey, the internet's going to be a really big deal. This is a place to invest. They got that right. The way it got interpreted was a whole bunch of people who had no clue about any of the technology involved just started buying anything that has .com in its name without thinking about it. And that, of course, resulted in the .com bust in 2000. I think what you're seeing now is it's very, very clear that the digital currency revolution is going to be a defining aspect of the next 25 years of human history. There's no doubt about that in my mind. Right now, most people think, just like the sophistication of the stock market in 1999 was, well, we're not really sure what all this internet shit actually is, so let's just buy anything with a .com in it. Bitcoin is clearly the most pervasive and popular cryptocurrency, so it must be a good thing to buy, right? I guess so, whatever. Frankly, I don't think people really understand the digital currency revolution that's coming or what it's about. We've got a lot of requests for why don't we talk more about it on MacroVoices. Well, frankly, MacroVoices is about macroeconomics. It's not really in scope for us. I am doing a full-length interview. I think it's going to be a really good one with a guy named Jan Pritzker, who wrote a book about Bitcoin. Jan and I agree on a lot of things, disagree on others. That's going to be next Wednesday, September 9th. And it's on the Swan Bitcoin YouTube channel. And as I understand it, it's going to be actually airing live. So if you want to tune into that, I'll have lots and lots to say about digital currency, about Bitcoin, about the reasons that I don't think the market is correctly interpreting what's going on at this stage of the digital currency revolution. But it really doesn't fit into what we do here on MacroVoices. So that's why we're not covering it on this particular show.
Listeners, if you want to tune in to listen to Erik do that, we'll include the link in the Research Roundup email. So, Erik, let's move on to chart 13, page 13 of the chart on the 10-year Treasury yield. And I just really wanted to point out something we talked about in the market wrap earlier, which was it really looked like those yields were trying to break out last week. And there was a lot of people that were talking about the fact that the Fed was going to let the inflation run hot, and it was starting to kind of spook everyone on the 10-year Treasury yield. And then suddenly in the last 5 days, it's just been straight down from there. And we're down right now about those 62 basis points. It'll be really interesting to see whether or not bonds confirm a sort of a risk off. I still think that they're the canary in the coal mines. And if we see yields breaking down to 50 basis points or lower, I don't know how the stock market is going to like that. So, I mean, this is something that it's at least something I'm going to be watching very closely next week.
Patrick, before we wrap up for this week, I want to just mention to our listeners, we didn't have time to go into detail on the calendared straddle strategy, which Patrick has been working with his Big Picture Trading members. For Big Picture Trading, folks, you guys, my hat's off to you. You've been raking in the dough with that strategy because you rolled your straddles up right at the top of the market, and I know that's been very profitable. For anyone who is interested in that, we don't have time in today's show to really dive into it, but if you move on to page 14, you can get a free trial to Big Picture Trading where you can find all about that. Patrick does 4 webinars every single week, and recently they've been focusing on that calendar strategy and how to roll it up and really maximize profits in what Patrick very accurately called as at least a short-term market top. The information on that is on page 14, or you can just go to bigpicturetrading.com and sign up for a free 14-day trial.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.